this is ACC Amit Kumar, and we'll discuss IFRS 8 operating segments. So I'll give a brief background of it. IFRS 8 operating segments is the standard dealing with presentation of the segments wherein we have majority stake like 10% of revenue, 10% of assets, 10% of profit or loss. There are quantitative thresholds, there are aggregation criteria. We need to disclose the operating segments. Why this is required? If you remember the example of Honda, there was a flood in Thailand, and since there was flood in Thailand, there was one component which was supposed to be used in Honda cars. All the Honda cars, wherever they were being manufactured, their manufacturing got halted because of the flood in Thailand. There was a nuclear disaster in Japan, and Infosys has to shut down their operations for some time. So why do we need this information? We need this information that which products or lines of services the entity is dealing in and which geographical locations they have. So earlier they used to be divided into primary segments and secondary segments. So what happened that we had a standard wherein we were dividing it into, there was a standard known as IS 14 operating segments earlier, which had been withdrawn now. Operating segments was based on primary segments and secondary segments. Whether our product or line of services is important to us, we show it in terms of primary segments and our geographical locations. If geographical location is of importance, it was considered as a primary segment. Now in IFRS 8, it says that it is not based on now primary or secondary segment. It says that if the chief operating decision maker reviews any segment in terms of revenue or expenses, that becomes a reportable segment, that we need to report that segment. So it is no more in the category of primary or secondary segments. So what happened in India, we had been following the guidelines as issued by IS 14 operating segments. But IFRS 8 or ISB felt that SFAS 131, which is by US GAAP, gives better presentation. So they withdrew IS 14 and IFRS 8 was introduced, which had CODM or Chief Operating Decision Maker as the criteria for deciding whether it is operating segment or not. In India, IndAS 108 is in line with now IFRS 8 operating segments. So it took time. We earlier were following the guidelines from according to IS 14, but since IS 14 is withdrawn, we have no choice now. With the introduction of IndAS in India, we are back on track now. Whether it is US GAAP or Indian GAAP or whether it is IFRS, we all are using the same criteria for deciding our operating segments. So anything which is being reviewed by Chief Operating Decision Maker is considered to be a reportable segment. So there is a decision tree. First, we look at the aggregation criteria. So the first is management approach. Anything which is being viewed by management is considered to be a reportable segment. Second, we use aggregation criteria. Aggregation criteria says that if majority of the economic characteristics are matching, economic characteristics are similar, we can aggregate them to present as a reportable segment. Now in aggregation criteria, it is the segments have similar economic characteristics and are similar in respect of nature of products and services. Like we are selling a razor with blade. nature of production process, type of class of customer. The person who is buying the razor is also going to buy the blade. The distribution method is almost same, and the regulatory environment in which we are operating is same. So we are having two products which we are selling. If the nature of the products and services, nature of production process, and type of class of customer, distribution method, or regulatory environment is same, if it is meeting all the economic characteristics, it comes under the purview of aggregation criteria. If it meets the aggregation criteria, we club it and we show it as part of a reportable segment. Then we use quantitative thresholds as a basis for identifying reportable segments. Quantitative thresholds. Among quantitative thresholds are based on revenue, based on assets, and based on profit or loss. Now we know our total revenue which we are earning. Now all the segments which are reporting 10% or more of revenue, they are reportable segment. All the segments which are representing assets of 10% or more of total assets of the group, 10% or more of total revenue, they are considered to be reportable segments. In case of profit or loss, it has to be 10% or more of, greater of, all the companies, all the entities which did not report loss, and all the entities which reported profit. So we'll look at examples of it. Quantitative thresholds. An entity shall report separately about an operating segment that meets the following criteria. Reported revenue is 10% or more of combined revenue of all operating segments. This will represent the reportable segment. Profit or loss is 10% or more of, greater of. Combined profit of all segments that did not report loss, and combined loss of all operating segments that reported loss. So we'll combine or club the segments which are reporting loss, and we'll club the segments which are reporting profit. Whichever is higher, loss may be higher of all the segments which are reporting loss, or profit may be higher, whatever it is. In absolute amount, we'll take that amount and we'll set the criteria as 10% of that amount, which will help us in decision making whether it is a reportable segment or not. Third category is assets. If assets are 10% or more of combined assets for all operating segments, we'll report that segment as a reportable segment. Let's have a look at the examples. Reported revenue is 10% or more of combined revenue of all operating segments. So herein there are 5 segments on the basis of geographical presence. The revenue from each segment is 5,000, 3,000, 25,000, and 15,000 and 17,000. We'll take the 10% of revenue of total. The total revenue turns out to be 65,000, and so the quantitative threshold is 6,500. If any of the segment is reporting revenue more than 6,500, becomes a reportable segment. So UK is reporting a revenue of less than 6,500, it is not a reportable segment. UAE is not a reportable segment. India is a reportable segment because it is reporting revenue of more than 6,500. US is a reportable segment, France is a reportable segment. This is how we decide the reportable segment on the basis of revenue. If I look at assets, in similar fashion, we'll take into account the total assets of all the segments. The assets with UK are 50,000, 30,000 with UAE, 250,000 with India, US 150,000, France 170,000. The total assets are representing 650,000, and 10% of total assets is 65,000. So all the segments which are having assets less than 65,000 are not reportable segments. All the segments which are reporting assets more than 65,000 will be considered as reportable segment. So revenue and assets are simple. The third category is profit or loss. Now we need to read it very carefully. We need to break this line. First, profit or loss is 10% or more of, greater of. Read from the point greater of. Greater of combined profit of all segments that did not report loss. We'll combine all the segments which are reporting loss. So if you look at UAE India and France are reporting loss. What is the total of the loss? The total of the loss equals 19,000. Combined profit of all segments that did not report. That reported loss is 19,000. That did not report loss is UK and US did not report loss. So entities which are giving profit is 1,000 plus 10,000 equals 11,000. Break it, greater of these two amounts in absolute terms. The greater of 11,000 and 19,000 is 19,000. So we'll take 10% or more of greater of 19,000. So 10% or more of greater of 19,000 is 1,900. Now all the segments which are representing whether profit or loss more than 1,900 are reportable segment. Whether their loss is more than 1,900, whether their profit is more than 1,900, they are considered to be reportable segment. So UK is a reportable segment or not? No. UAE? No. India is a reportable segment, US is a reportable segment, and France is a reportable segment in terms of quantitative thresholds, or profit or loss is 10% or more of greater of all the segments which did not report loss, all the segments which reported loss. In absolute amounts, it is 19,000. Will not be emotional here in case we'll be very emotional with profit. So we believe that it always has to be profit. So here it wants us to look at it in terms of materiality. Which amount is greater becomes the quantitative threshold criteria. So 19,000 is the greater of the two amounts. 10% of 19,000 is 1,900. UK, UAE are not reportable segment because it is representing less than 1,900 in absolute figures. The loss is less than 1,900. Here the loss is more than 1,900. US profit is more than 1,900. France profit is more than 1,900 in absolute terms. So these three are reportable segments. UK and UAE are not reportable segments. So the decision tree is that first we'll identify operating segments based on management reporting system. Wherever the chief operating decision maker is reviewing them, they become reportable segments. Second is aggregation criteria. We discussed about the similar economic characteristics. If they are meeting all the criteria, they are reportable segments. Aggregate segment if desired, if only management wishes so. Otherwise, we'll move forward and we'll look at the quantitative threshold. If they meet the quantitative threshold criteria, they are reportable segments without doubt. They are reportable segments without any doubt. These are reportable segments. So aggregate only if the firm desires. If it is meeting quantitative threshold criteria, it automatically becomes a reportable segment. There is no choice then. Further, we'll see that do remaining operating segments meet a majority of aggregation criteria, that out of the economic characteristics we discussed, nature of products or services, same distribution method, same regulatory environment, if they are similar in nature, out of the majority of, earlier we were looking at all the economic characteristics. Even if now majority means 3 of them are matching, we still can club them and aggregate if we feel to make it a reportable segment. So there's a requirement that we need to present at least 75% of entities revenue as reportable segments. Remaining comes into all other segments category. So we need to report additional segment if external revenue of all segments is less than 75% of entities revenue. What does it mean? Means that if total external revenue reported by operating segments is less than 75% of entities revenue, additional segments need to be reported until the 75% threshold is reached. Segments that do not meet criteria may also be reported if management believes that such information will be useful to users of financial statements. That is management approach. Segments not meeting the quantitative thresholds can be combined with each other to produce a reportable segment only if they share similar economic characteristics. The one aggregation criteria we said that after quantitative threshold, if we need to show some more reportable segments, we can use aggregation criteria again. And finally, we also need to use 75% threshold criteria. Information about other business activities and segments that are not reportable shall be combined and disclosed in all other segments category. What does this mean? That When we are trying to report these segments, UK, UAE, India, US, and France, and there may be many others. Now UK is representing 20%, UAE is representing 15%, India is representing 25%. US is representing 10%. I'll take Finland for avoiding confusion, otherwise you'll relate it to the previous example, and Australia. Suppose this is representing 9%, this is representing 8%. And all the segments which we could not report are normally termed as other segments remaining. Now, among them, the reportable segments till now are UK, UAE, and India. These are reportable segments. Now, when we total these, the external revenue of all the segments which we consider as reportable segments, when we totaled up, it turned out that it is 60%. We need to achieve 75% threshold criteria as well. Now, for that, we may report additional segments by clubbing the segments which have similar aggregation criteria. We can use that criteria, or if that also doesn't match, then we can club 2 or more. So what shall we do? If we have Australia, New Zealand, Oman, say 6%, and 17% is representing all other segments. Now, these 3 are clearly reportable segments. These 3 we have to report anyway. Which others among them? They're all other left, and 3 we have identified which we can use as reportable segment. Now, which 2 you think will bring forward? If we bring Finland forward, we need the support of either Oman or Australia. What do you think should be reportable? Finland or Oman, or Australia and Oman? If we represent, we still are short of 14% to be reached 75% threshold. We can club Finland and Oman and can present them as reportable segment, and club this Australia as part of other segments category. So there is no fight for that only the higher ones we need to include. That's not necessarily the case. We can even bring forward Finland and Oman and report them as reportable segments as part of our 75% threshold criteria. If they enable us to meet the 75% threshold, all other segments will then be represented by 25%, becomes all other segments. This is how we'll be meeting the 75% threshold criteria and present our reportable segments. Any doubt in this? Anyone having any doubt relating to quantitative threshold, relating to aggregation criteria, relating to meeting 75% threshold criteria? Anyone having any doubt till now? Hello. Banu, Birpal, Hima, Nitika, Prachi, Sapna. Okay, fine. So if I go back to the decision-making criteria, so if you look at here, first management approach, second aggregation criteria, third quantitative threshold, they become reportable segments. Then to meet 75% threshold, we look at aggregation criteria again. If not, then we club some more to account for 75% threshold, and then we aggregate all others into all other segments category. This is how we prepare operating segments presentation. We'll look at it again. fresh. The objective of it, the scope, the operating segments definition, reportable segments, quantitative thresholds, and aggregation criteria. If segments are not meeting the reportability criteria of 75%, what we need to do, how to deal with prior year adjustments. So IFRS 8 requires that an entity should disclose reliable information to enable users of financial statements to evaluate the nature and financial effect of the types of business activities in which it engages. Types of business activities means products or lines of services, the geographical locations they are located, because this may impact the users of financial statements in future if they are not aware of where and how things are happening. Like the case of India, Vodafone, the case study of Zio, and an investor in Vodafone, all the joint venture investment here, they have written off to zero. Now, if this information they had known in advance, if they had known about the environment that there's one of the investment is done in India and the environment there is that they're struggling and there's a lot of competition, the users of financial statement can evaluate their situation if they know this information. So this is disclosed through operating segments. So IFRS 8 applies to separate or individual financial statements of an entity and consolidated financial statements of entity. Consolidated, the same principle or the reason for which we prepare consolidated financial statements, the same reason are applicable for producing operating segments as well. If you're presenting consolidated results, we are also required to present operating segment report as well. The ones whose debt or equity instruments are traded in the public market or in the process of filing, they are required to present consolidated financial statements if they have a subsidiary on the last day of the reporting period. Entity is not required to apply IFRS 8, but if they voluntarily disclose segment information, shall not describe it as segment information. Segment information is only presented when it is required by the accounting. If someone presents that on their own without even requirement, that will not be considered as segment information. So operating segments are components of an enterprise that engages in business activities from which they may earn revenue or they are incurring expenses. If they're spending money even on head office, and if that head office expenses are being reviewed by the chief operating decision maker, that head office also becomes a reportable segment whose operating results evaluated regularly by chief operating decision maker. Chief operating decision maker is not necessarily one individual, it may be board, it may be group of people who are taking decisions in deciding how to allocate resources and in assessing the performance. If their focus is on these areas, that same focus should also be allowed to be known to the users of financial statements so that they can also take better informed decisions. This is the reason behind it. So IS 8 applies to segments yet to earn revenue. They are investing, but they're not earned revenue. Vertically integrated operations, what are the relationships where they are integrated or they are supporting those operations because of spending money on them. Discontinued operations, operations being wound down, joint ventures, or anything subject to conditions. A condition for identifying an operating segment is that its results should be regularly reviewed by a chief operating decision maker. This approach to identify segments is known as management approach. This is a change from the previous way of presenting operating information to the new way of presenting operating information under IFRS 8. That is, management approach is important. Whatever is being reviewed becomes a reportable segment. IFRS 8 requires an entity to report financial and descriptive information about reportable segments. Reportable segments are operating segments or aggregations of operating segments that meet specified criteria. Either they meet aggregation criteria, either they meet quantitative threshold criteria. We have already discussed the decision tree. If anyone has any doubt, please ask. Aggregation criteria we have discussed. When two or more operating segments can be aggregated if they have similar economic characteristics, and if all of them are matching, we can club them. Quantitative thresholds we have discussed. Though my style was different purposely because unless we understand what is a quantitative threshold and what is an aggregation criteria, there is no point we can reach the decision tree. We have discussed this slide as well. To meet the quantitative threshold of 75% criteria, all the segments into other segments category. So prior period adjustments. If an operating segment identified as a reportable segment in the immediately preceding period, and if it is of continuing significance in the current period, such segments shall be reported separately in current period as well, even if it is not meeting the quantitative threshold criteria. If the management believes that it is of significance, we should report it again. If an operating segment is identified as reportable segment in current period, but was not identified in previous period, prior period comparative data shall also be restated to present so that the users of financial statements can compare. If an entity changes structure of its internal organization in a manner that changes composition of his reportable segment. This information for prior periods will also be restated and informed to the users of financial statements. This is a requirement of IAS 1 that if you're presenting something in the current year, you need to present a comparative of it of the previous years as well. So an entity shall disclose following information: factors used to identify entities' reportable segments, types of products or services in which the entity is operating and derives its major revenue. So entity shall report a measure of P&L, assets and liabilities, revenue, because that is the basis for calculating the quantitative thresholds. Revenue from external customers, because that is the basis for 75% threshold. Revenue from transactions with other operating segments in the same entity, to see any related party relationships, interest revenue, interest expense, depreciation, amortization, entities profit or loss of associates or joint ventures, income tax expense. So there is a separate segment information to be presented along with your standalone or consolidated financial statements of your amount of investment in associates or joint ventures or any non-current assets other than financial instruments, deferred tax assets, post-employment benefits, insurance contracts, whatever is existing related to these reportable segments, we need to disclose. Reconciliation needs to be provided. Total of reportable segments, which are representing revenue, P&L, and assets, because these become the basis for quantitative thresholds. We need to disclose all the reconciliation relating to how we arrived at reportable segment criteria. Entity-wide disclosures, this is again required to be made for an entity as a whole and not individual segments. Revenue from external customers, this becomes the basis for 75% threshold attributed to entity's country of domicile and to all foreign countries. Non-current assets located in countries, in entities' country of domicile and foreign countries, the total of non-current assets where they are located, so that this can help in taking better informed decisions. The majority of chunk of their non-current assets are in foreign countries, and if there is a war going on in that country, so it's obvious that it is not going to be reporting good profits in the time to come, and major of their stake is in those countries. So this is helping users of financial statements to take better informed decisions. Transactions with a single customer. What if this customer leaves? Majority of the revenue being generated from one customer representing 10% or more of entity's revenue. We need to disclose the name of such customer. This is all for IFRS 8 operating segments. If you have any doubts, please ask.